Welcome to FT Markets. If you're thinking of packing those snow boots and skis and heading for the slopes, just hang on a moment. This week comes that crucial Federal Reserve meeting with the market's expectation of a rate hike absolutely at the top. With me to discuss what might happen is Dan McCrum. Dan, it's been a really exhausting year for traders, hasn't it? I mean, and it's been not one with very little return for them, isn't it?
That's completely right. I think we've got a chart here which shows just how bad a year it has been for most people in the financial world. And we've got a selection of some of the different investment returns which people pay attention to. Gold isn't an investment, but we've got it there because we know a lot of charlatans like to pay attention to it.
Everybody knows what's been happening to oil this year.
Yeah, so oil has been a disaster. The price has collapsed again. And that is just a signal of sort of underlying lack of demand in the world, the state of economic growth.
But equities has been barely helpful.
Well, Europe and Japan, which are sort of the worse off economies, have been doing better, but that's only really because there is still economic stimulus coming from central banks. They aren't yet through their recovery phase. So people are still expecting that corporate profits are going to go up, and we're still going to have sort of a better year next year. Whereas you look at the S&P 500, we're essentially flat for the year, which is a very strange place to be as we're approaching only the first rate hike from the Fed on Wednesday. This would usually be the point where you think, aha, the recovery is gaining ground, and the Fed is just starting gently to lean against it. And yet the stock market, as far as it's concerned, it seems a bit torn. Is the economy getting better, or is this the moment when actually things are going to turn for the worse?
And it's been particularly troublesome in the run-up to this rate hike for the bond market, hasn't it? I mean, prices are falling. And what's causing a lot of that uncertainty in terms of, I mean, presumably it is the Fed hike, isn't it?
Exactly. There's some growing anxiety in corporate bonds. If you think about the riskiest forms of debt, the junk-rated high-yield bonds, triple C debt, the way the rating agencies look at this is to be a triple C rated borrower, the agencies think there's a 50-50 chance you're going to default on that debt in the next 5 years. This is really a coin toss whether you're going to get your money back. 18 months ago, because interest rates around the world were so low, people were willing to receive a 7% income in return for lending to these very risky companies. Over the last 18 months, those yields have been steadily rising. As you might think, a sort of a dose of reality about the true riskiness of these companies has been creeping into the market. So last week, yields on these bonds were more than 17%. And in the last few days, we've seen a particular bout of anxiety for the high yield market as a whole. There's been some mutual funds have been closed. There have been some hedge funds who have been liquidating their credit portfolios. And all of this speaks to a growing sense that as interest rates are finally going to rise, perhaps there is going to be a reassessment of credit risk within the entire fixed income world.
Okay, and it's all happening in what should be a quiet time of the year. But as our next chart shows, it's about to get very volatile. Dan, talk us through this one.
So December is normally the point when, as an investor or a trader, you don't want to be doing too much. You've either made if you've made a decent amount of money in that year, you don't want to put it at risk by taking on risky bets right at the end of the year.
You're closing your books, aren't you?
Yeah, you're closing your books, you're settling down, you're easing into the new year, and you think about, okay, what does the next year hold? However, if we look at trading in this December, you can see here we have the daily trading volumes for the last 5 Decembers, yes, including this one.
And this is this year. That's this one at the top, which just goes to show the number of trading days so far this year, of this month, and it's already higher than any of the last 4 years, isn't it?
And the previous most sort of busy December in terms of trading was 2011. That was the last terrible year for stocks. The US stock market was flat and you only made a bit of money on the dividend. And so it looks like we have a very busy December, so behavior isn't normal. And then we have the Fed decision on Wednesday, and then on Friday we have option expiry date for the S&P 500. And this is what usually causes the spikes in trading that you can see here. Yeah. So what we have is we have the first Fed decision, We have a large amount of uncertainty about what is going to happen afterwards. I think one of the key interesting things to think about there is when it comes to forecasts for economic growth, the market appears to be taking the Fed's best estimate of how the US is going to grow as its sort of baseline for what's going to happen next year. But when it comes to where interest rates are going to be, the market appears to be taking the Fed's lowest estimate of where the interest rates are going to be.
Dan, as I say, thank you very much. It's going to be pretty tumultuous the end of this week and the end of the year. So watch this space.